than that. And if you think about the gross number that you would get in a large settlement, you could assume that a larger defendant is not going to exit for less than that amount of money. And the way this works is like with any business where you have multiple customers, sometimes the first customers get the best terms. And sometimes when you run these things, you can explicitly say the first people who come out are going to get this rate, and then it's sort of like an auction process where if you get out at a certain point, you get better or worse terms.
Thank you.
Sure. Going back to DSS, DSS has an existing dispute with a company called coupons.com. This is a breach of contract dispute where basically DSS did what happened to Image Expo and lots of companies. They gave proprietary information to coupons.com under a non-disclosure agreement. Coupons.com ripped up the non-disclosure agreement, started using the information right away, and made money off of it. This is the case in the Western District of New York. It's a fairly slow jurisdiction. DSS has been managing this. We're not controlling this at this point, and we've been starting to try and provide DSS with advice about what to do with this case. But suffice it to say, we think that there are material damages in the case, and we look forward to taking this over once the merger happens. Then there are what I'm going to call latent disputes within DSS. There are license agreements they have that we're not so sure they're getting paid at everything that they should, and there are some other patents that they own that we think might be in use in the industry, and we're going to pursue those. So part of our growth strategy with DSS is to help them unlock value in IP that's in patents that are sitting on the shelf. So we think of, at this point, we have basically 3.5 irons in the fire, and to be fully diversified in this business, we want 7 or 10 portfolios, and that's where we're heading by the end of this year after the merger closes.
Peter, where do you get your pipeline of potential deals from?
So a lot of it's from word of mouth, just by reputation. We get them from investors, from some VC firms. We get them from bankers. We get them from law firms. And we get them, there's also sort of a brokerage industry. There are people who will sell patents. That's their whole job. There's a sell side of the business. And sometimes we'll take those, but usually those are more competitive. And so we prefer to have proprietary sourcing. All of our investments so far, Bascom Research was proprietary sourcing. It actually came directly to IP Navigation because the lawyer who sent it to IP Navigation had previously sent another portfolio that they sold for less than $1 million, and IP Navigation made about $40 million off of it. So that was a deal that never saw the market. Virtual Agility similarly came in with Jeff Rinaldi, who had a relationship with them. And so far, all the deals that we've looked at in the pipeline, we've looked at about 100 deals since November, and of those, I'd say probably 40% are proprietary sourcing, 60% are things that people have sent to us, where we think that there's some competition, and we haven't moved forward with any of the competitive assets. We've only been looking at proprietary source deals. I'm going to go to this slide, which is page 20. It's a complicated graphic. What this shows is DSS's new product. It's a digital product. And I said earlier, what DSS is really good at is making it very hard, making it be able to print something on a piece of paper that you just can't scan or copy successfully. What this technology is, about 5 to 7% of global trade is counterfeit. And the way that you create counterfeit is very simple. You go to the store, you take a box off the shelf, you take the box and you unfold it, and you color copy it, and you make a new box, you put a fake product in. And when you color copy that box, you copy the barcode, you copy the QR code, the TV barcode thing, you copy all this, any identification or security feature, and if you scan that barcode or that QR code, it'll read just fine. What DSS has is a proprietary technology that, again, if you put, it's like a digital watermark that they put onto packaging, and if you scan or copy it that way, it won't print out properly. And the way that you read that watermark is pretty cool. You read it on any standard smartphone scanner. So if you have an Android device or an iPhone 5 or above, you can scan this icon on the package, and it will tell you if it's been counterfeited or not. It can also tell you for a brand owner, for like Pfizer, with counterfeit drugs. What Pfizer wants is not just that the mark's on there and somebody can scan it and see if it's real, but they also want to know what week was this produced, what market was it for, and all the other sort of supply chain information. So this is an exciting product for DSS. Sales of one of these software suites would probably have revenue potential of around $2 to $5 million a year, and this product adds no additional cost to the supply chain, and it's sort of a 60 to 90% profit margin for a company that has currently something like $2 million in licensing income. This changes the game in terms of what they're able to earn in that business. There's also another important feature about this technology, which is that it's been heavily, extensively patented. DSS hired somebody named John Cronin, who's well known in the industry, to help them patent all around this technology. And what we expect to happen, so far DSS has launched this technology, they launched it in October of last year, and so far they have about 16 non-disclosure agreements with large companies to kick the tires on the technology. DSS is still a small company, and we think that two things are very likely to happen. We think that they're very likely to get some sales because of the level of interest that we've seen. We also think it's very likely that some companies are going to say, this is a really great idea, and they're going to learn everything there is about the technology, and then lo and behold, they're not going to go with DSS, but they're going to produce something that looks very similar to it, and we're going to be in a position to enforce the patents when they issue in a couple of years. And this is, I think, a very important illustration of how the strategies work together and why you want to work with an operating company in the first place. Operating companies are actually damaged when somebody infringes their patents. And the reason this is important, a couple reasons. When operating companies go to trial, they're able to get what's called lost profits, and they're also able to get what's called injunctions. So you can actually stop somebody from making a product that infringes your technology. This is very different from a company that can go and just get a royalty payment from someone that's using their patents. Since 2006, there's been a law in the US where if you're a non-practicing entity, you can only get what's called reasonable royalties. That means you can get a portion of what somebody else is earning from using your patents. If you're an operating company, it's very different. You can stop the company from making a technology that infringes your patents. If any of you remember RIM versus NTP, anyone remember this case? NTP got $613 million award from RIM. The patents that NTP asserted against RIM were overturned within 6 months after RIM paid $613 million to NTP. And the reason why RIM paid them all that money is because NTP was awarded an injunction. The judge said that NTP can stop RIM from selling handheld devices that deliver email. That's very different than saying RIM might have to pay them 4% royalty rate. And I think the last offer that RIM had before they went to trial was something like $10 million to settle. So if RIM had existed today, if NTP had existed today, they would have either gotten $10 million, or more likely they would have gotten nothing, and they got $613 million. Now this is an extreme example. Not all cases in not all cases can you get an injunction. There are specific circumstances where you can, but it's an illustration of if you're invested in operating businesses that have the potential to assert patents, they have structural advantages over companies like Acacia and Wyland that are never able to do these things. And this is very important for anyone that's followed companies like Ringo or Renetics that have sought to assert patents that have been successful. They've had some challenges in holding onto their awards. So I think what we expect with DSS with this digital product is that there's going to be an opportunity to commercialize the technology now, and in 2 years or so there's going to be an opportunity to license the technology. And this is kind of how our investment approach is going to work with pretty much everything we put money into going forward. DSS itself burns about a little over $1 million a year on a cash basis. This is something that we have a very clear plan to fix, and it's something that we expect to have fixed by the end of this year or within 12 months. This is not a company that hemorrhages cash. It's a company that has, with a couple smart moves, including some refinancing and probably some small consolidation, is going to get to cash flow break even. And we think the packaging business itself, which fits with this new digital offering, grew 60% last year on its own. And the company as a whole grew 28% on a revenue basis. So we think that the company is still going to continue to grow. We think that with the introduction of the new digital product, it's going to become more profitable. And the goals for DSS for 2013 are basically get profitable and have some success with this digital product and help us work on unlocking the potential in the patent portfolio. Simple as that. Those are the key elements that we would have with any one of our investments. For us, for Lexington, merger is going to close July 1st. We have the Markman hearing coming up in October. With virtual agility, we're likely to initiate additional litigation. With Bascom, I've already said we're going to initiate additional litigation. And then we have a pretty robust pipeline that we talked about. And my last job before this was to help my previous company, IP Navigation, raise private money to fund patent litigation. And Jeff Rinaldi, the CEO, has similarly done a lot of fundraising in his life. So to be diversified, we want another 3 to 5 investments this year. And because we're also focused on the fact that we want the stock to be $5 for a period of time, we're very likely to be very careful about how we use our balance sheet in the coming year. So we plan to diversify, but we don't necessarily plan to raise a lot of money to do it because it's counter to our investors' interests. And I think that we'll probably be in a position to announce an additional acquisition or 2 this summer before anything happens in the Bascom case as well. So I know this is, I've been talking for a while, this is a lot to take in, I think, and I'd probably a good time to open it up to any questions you might have.
Peter, question. Obviously a first question. Going back in time, you're probably very familiar with the intimate wiper fiasco that lasted for years.
Yes.
Detroit fought that for what, 20, 30 years, basically through appeals and everything else. Obviously, yeah, there was a settlement. What is your staying power? Obviously, Detroit, General Motors, Chrysler, and the other defendants wouldn't accede to any demands based on the fact they would outlive, or the staying power of the other side. What is your staying power to stay in this litigation, if something of that nature?
Well, there are a couple of things. That guy, I actually never saw the movie. I have to see the movie. But my understanding is he was kind of a maverick and tried to do it himself. And when we make an investment, before we actually make the investment, we know that we have contingent counsel lined up. We know that we have a co-investor who's willing to put $4.5 to $5 million worth of their fees in for a share of the outcome. And also, if we're investing in an operating company, we know that they're committed as well. But in terms of capital, we have $8 million in capital because when I raised money last summer, we raised money at around a $50 million valuation with our management team and one asset from very experienced investors. I I didn't need to raise more money. But raising capital is something that we're very comfortable doing. And anyone facing us knows that we have not only a management team that's done it a lot of times, but we have access to a lot of money. And going back to private versus, in this case, I want to be very careful with this balance for the first year. We're as big as any defendant. And that's always going to be the case, and they know that. And they especially know that because of who's talking to them. And whether it's Eric, or if it's Jeff, or if it's somebody else that has done this many times, a lot of times it's not the first time they've done business. So it's just a completely different story in terms of who the plaintiff is. It's true. I mean, see, that guy needed our help. If we had worked with them, if we'd given them the money to make the next, better wiper blade, we would have made a ton of money off of the old technology. And it would probably have been a different story.
A couple $100 million?
What's that?
Wasn't the eventual settlement about $250 million?
I have to see the movie.
I didn't see the movie, I never saw the
I
movie.
have to see the movie. It's I've been too focused on other things, but we suffice it, the bottom line, we're as big as any defendant. We have the staying power of any defendant, and the defendants know it, and that's why they settle early, and that's why they settle for real money.
On your merger strategy with getting the 40% bonus, starting at 50/50, do you get to capture that net loss carried forward? You wait a year, you get the 40%.
Well, the net loss carry forward is going to depend on who's determined to be the accounting acquirer anyway.
But if you're,
And one of the reasons this merger is taking such a long time is because we spent 9 weeks with the SEC accounting examiner hemming and hawing about who the accounting acquirer would be. And then the SEC examiner said, I don't know. We'll find out after the merger. And so we actually, if you look at our S4, if you want to read all 400 pages of it, there are actually 2 sets of pro formas that show if we're the accounting acquirer, if they're the accounting acquirer. And so the ability to get the net loss carry forward is going to depend on that anyway. But to your point, if we are the accounting acquirer, if that condition is met, it would lean towards our ability to get the carry forward.
it would.
It would. Back there.
Obviously, you're talking about your successes, but in all litigation, there is not all successes. What do you consider one of your biggest losses?
Personally,
As far as litigation in patent suits tend to take and be really difficult at best. And proving your point is even worse, and it's not only costly, but also not always vindicates the individual.
so with money that we deployed at IP Navigation, we had 15 portfolios that we took on when I was there, and one of them was pretty much a total loss. One of them didn't return anything. It was like, we got 80 cents in the dollar, and then we had a few that were, made something like 20 to 80%, and then we had a number of them that made multiples. So I personally, as an investor, don't have a ton of failures to talk about, but I mean, it's something that happens all the time, so IP Navigation did have a case before I came there where they got a judge in Wisconsin who really didn't like the case, and they basically got crushed. But recently they just went through appeal with Hyundai and got a big award. So that model has had 3 trials, 3 things go all the way to trial and appeal, and they've won 2 out of 3. Jeff, if you look at, if he were here, he could tell you more about his successes and failures. He has an unusually good track record, and this is part of, there aren't that many people who do. He had a case, he would call a failure a case where they actually just got a $10 million award that was amplified to $20 million against Citrix. This is a judgment. They have to see how much they settle for, because his investors were expecting a $50 million return. And that was something where, when that happens, not everybody involved with that gets paid. I don't think he's never had a trial. If he were here, he'd tell you the same thing. He's never had a trial that he's lost. He's had some investments that didn't return too much, but again, it's not all win or lose. You make money along the way, and if you know what you're doing, when you're at a certain point in the case, you've made enough money to cover most of your principal investment. And this is going back to, for example, virtual agility, which is a Jeff deal. We have a multiple, we're going to put in up to $2 million over time. We're going to own 7% of the equity in the company, so the physical assets, and then we get a multiple of the money that we put in off the top, and then money thereafter. So it's very, with that case, it's very weighted in our favor. The risk is weighted in our favor. So even if that case turned into something that was not a commercial success by anyone's imagining, we would get all of our money back and a little bit extra, plus an equity slug. So it's, I mean, we'll have wins and we'll have losses. I personally, I've had patent sales that didn't work out well. I mean, you win some, you lose some. But we're focused on getting people involved with this who know how to balance the odds in their favor.
Can you give me a little more flavor about this, the number you said? 64% of 150 million came in the first 9 months?
Yeah, it's actually 64% of about $600 million.
600.
So the traditional model is you file a case, somebody settles for a number, and then you file more cases after you've established a royalty rate. And what happens is the second set of cases you file, you have a very fast settlement period. So I say it is within the first 9 months, but there's kind of some bias in it because some of those first 9 months were after a rate had already been established. And that's why it's basically before market. But 64% of the money they've made, hundreds of millions of dollars, has come before their investment reached the marketing stage in the case.
I'm trying to figure out something. You're Lexington,
Yep.
making a presentation, who's going to be merged into DSS,
Yes.
okay? I am trying to figure out what the relationship is and your advantage. You're making the presentation, it seems like you have all the goods, and you're being merged into DSS.
Well, we're taking over DSS.
I'm trying to understand
Well, DSS.
what DSS has to offer you.
Sure. So DSS has their IP portfolio, they have their product set, and they have an operating footprint, going back to the having an operating company. One thing is, if I acquire IP assets that no one's using, and I give them to DSS and they have an operating company, I've already increased the value of those patents because I put it into the operating company that can pursue it as an operating company if they license it or go to trial. So that's one thing. Having an operating company is an asset that nobody really pays attention to, and this is a pretty good operating company. I like this operating company. I like their new product. I like the management. I like being able to, if I'm a plaintiff in a case and somebody asks me, so what is DSS about? My answer to them is, well, DSS employs 100 people in upstate New York and in San Francisco, and their main product is something that protects everyday consumers from fraudulent goods from China and India and third world countries. That's very different than saying, well, I live in New York and I bought some patents and I'm making money off of it. It's a human process, it's a judge and jury, and being a better plaintiff is worth something. DSS also has historically been an IP-focused company, and a lot of the shareholder base has been, kind of understands the story. Long term, so I talk about in the first year we're focused on this $5 number, but you could ask the question, why on earth are you doing this in a public company, right? It's really hard. We're going to have Sarbanes-Oxley, we're going to have lots of stuff. You have to report every time you make money. You have the defendants looking at it. Why on earth would you do this?
Because you could be worth a fortune.
Because I want the cost of capital. Because I've spent a lot of my career raising money in private, and I want the cost of capital. And if I can produce something for investors where investors who want to get into the IP asset class, they have better upside because I'm an operating business and I can get better rewards than other companies that are in the space. They have better downside because I have physical assets that have a real value that you can get your hands on and that we're improving the value of. I have better transparency because I can tell you what all my operating businesses are doing, and I can do my best to say this is the calendar of events for the patent world. And I have a platform where, because of the cost of capital and because of the other things that we've built, I can go to some of the other people who've made tons of money in this space and say, come over here, bring your business, bring all your relationships, bring all your deal flow, and I can increase the value of what you have. And we have equity currency, we have a lot of advantages. This is a long-term play to build a business model that is worth, absolutely, it's worth a ton of money. But the cost of capital and the use of the access to public equity is a strategic part of what we're doing. There's and DSS has that.
Peter, looking at the market cap post-merger, I'm looking at 20 million shares plus 22 million for DSS, 5 million warrants, 7 million escrow, that gets you to 34 million shares times 5 is I'm sorry, 54 million shares times 5 is a $270 million market cap. If those numbers are right, do you have the pipeline within this next 12-month period of time to get it to a $270 million market? Is that
We do. I think it depends on how excited people are about us on the one hand, which is something that we're trying to get people to appreciate. But the simple answer is absolutely yes. If you value us based on our ability to deploy capital and return a multiple of that capital with the investment deal flow that we've seen since November, the answer is absolutely. I think of it as the $5 valuation, the $5 number is around 250 million market cap. And I think that in 18 months, we should be in a position, 18 months, 24 months, we should be in a position to be like a $500 million market cap, equivalent to Wyland, the company I mentioned earlier in the presentation.
so those comps? What are the metrics on those comps? What are you performing that against? Versus EBITDA versus total revenue? What do you?
I think that there aren't great comps in terms of, for a while it was companies were trading at around 8 to 10 times revenue. And I think that on that metric, no problem.
Peter, I'm personally intrigued by your presentation, and I look forward to speaking to you privately, but I'd like to understand why you do this type of presentation tonight. Are you here to increase awareness? Are you seeking capital? Or is there another objective?
It's strictly to increase awareness. At this point, it's something that's, it's a complicated story, and what we're trying to do is get people to understand how we're different so that we're not lumped in with other companies that are in this space. And as the merger's happening and there are significant events, what we want to do is bring people in who are interested in the business model and are going to be with us for a few years until we dividend you out or something. And that's what we're doing. At the same time, naturally, of course, we have a proxy process that's ongoing. We're very confident about delivering the vote, and we want people to understand what we're doing and get involved. But we're not raising money.
Just want to clarify.
So the question that came out at our meeting yesterday that I wasn't familiar with, the Obama administration, are they actually putting pressure on the non-operating? I hadn't heard that before, so.
Yeah, this is something where, I guess on the downside risk, it's something that who knows what's going to happen, if anything's going to happen with additional patent reform, but clearly we're going to be more insulated from any activity that the administration is going to take against non-practicing entities. And that's something that seems increasingly certain. I don't like to bring it up because it kind of reflects badly on some of the other companies that are in the space, and it usually leads to a question about what's going to happen to them. I'd like to just say I think that we will be significantly insulated from anything that the administration comes up with, because we're not a non-practicing entity, we're a practicing entity.
But there is rumblings that they want to curtail something.
Yeah, I think that, so the problem with the SHIELD Act as it was originally written is that it was going to be contrary to IBM and Microsoft's interests as well, because IBM and Microsoft engaged in some of the activity that would have fallen under the SHIELD Act. For example, Microsoft bought $1 billion patent portfolio from AOL. It's not IP that it invented, and it bought it in an area where it has no product. So it would have been subject to these rules, the loser pays rules, and I'm certain that Microsoft was not happy about that. So I think it will not surprise me if there's patent reform legislation that comes out that